Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Professor Patricia Kane from Santa Clara University School of Law. And I'm going to just call her Pat. She has been teaching law for over 39 years. It must be somebody else.
Surely.
Yeah. Anyway, she briefly practiced law before she became a professor, member of the Texas and Iowa bars, and she provides consulting services to law firms. Patricia is a frequent speaker relating to tax planning for same-sex couples, and has written many law review articles on that subject. Today we're going to be talking about federal tax developments for same-sex couples, and the date today is January 7th, 2014. This is sort of a moving target, although hopefully some things will be more settled, particularly related to married same-sex couples. But just be aware that there are developments that are happening all the time on this, particularly because of some of the recent changes. As I caution you again here, we are discussing issues in a very complex area. This is a starting point for a bigger discussion. We want you to get legal and tax advice. Also, we're mostly talking about things from federal and California standpoints. So, for example, California is a community property state, and we have our own flavor of community property. It varies from state to state. Viewers in other states should seek advice about their local laws. Pat, thanks for joining me today.
Sure, anytime.
It's always a pleasure to have you, and particularly because this has been such an active subject.
A moving target.
Yeah, to be dealing with the last few years. So maybe you can bring us up to speed again a little bit about what's happened with same-sex couples over the last few months as far as this Supreme Court ruling and maybe some of the things that have happened afterwards.
Sure. This all began, well, it all began years ago in 1996 when Congress enacted the Defense of Marriage Act and said that the federal government would not recognize any married couple as married if they were of the same sex. And on June 26, I was on your program shortly after that. On June 26, 2013, the Supreme Court, in a case called Windsor versus United States, struck down that law as unconstitutional. Now, when a law is struck down as unconstitutional, it usually means it was always unconstitutional. It doesn't just, not like a statute that's passed in changing the law, so it has retroactive effect. What we didn't know after Windsor was how much retroactive effect and which marriages would count. Edie Windsor married her long-term partner in 2007 in Canada. They lived in New York, and New York recognized the marriage. So a lot of people thought that the only marriages that would be recognized by the federal government, or at least by the IRS, would be same-sex marriages in states that recognize those marriages. Then finally, the federal agencies started announcing that wherever they could, they would follow a state of celebration or place of celebration rule rather than a state or place of domicile rule. And finally, on August 29th, the IRS issued its revenue ruling taking the same position. So wherever you're married, so long as you're married in a state that recognizes it, even if you're living in a bad state, a state that has its own state Defense of Marriage Act and therefore doesn't recognize your marriage, you count as married for federal tax purposes.
Right. And meanwhile, though, you may not for state.
You may not, we don't have to worry about that in California because, of course, the same day that Windsor was handed down, Perry was handed down saying that there was no standing in that case, and therefore the district court opinion that had struck down Prop 8 in California was the final opinion in that case, and so marriage equality is the law now in California.
Right. And, of course, since then, we've had a number of other states that have been recognizing marriages.
Oh, yes. We're up to, depending on how you count, 17 or 18 states by now. I mean, the most recent thing that has happened since you've identified the date, of course, is that there was a successful a law in the state of Utah. The district court opinion ruled that that state's baby DOMA, their Defense of Marriage Act, their requirement that you be of the opposite sex in order to get married, that ruled that that was unconstitutional under the federal constitution and refused to stay or put a stop on his order. So in December, loads of Utah same-sex couples were getting marriage licenses and getting married. The state then asked the 10th Circuit, which is the appellate court, to stay that ruling, and the 10th Circuit said no. So they petitioned the United States Supreme Court, and just a couple of days ago, the United States Supreme Court issued a stay. So there'll be no more marriages in Utah, but there's lots of debate. It was all over the New York Times this morning. Are those people who are married in December, under the district court opinion, are they legally married for tax purposes? We'll have to wait and see. I think there's a good chance they are.
Okay. So we'll see. This is evolving. Fortunately, again, the issue is settled here in California, so particularly as a tax practitioner here in California, it may make life a little easier. But for those in other states, they have to deal with these conflicts. Again, so for example, you may be filing a married joint income tax return, but
at the federal level.
At the federal, for your federal tax return. And there are some states that actually require, we were talking about this yesterday in another class I was in. So for example, in North Carolina, you start with the federal tax return.
Almost all states, not all, but almost all states that have an income tax base it on the federal return. So you start with your federally reported adjusted gross income as the beginning for your state return. A number of states have announced what they're doing about this conflict. In fact, Utah is one of those states that announced quite early that even though you're filing jointly at the federal level, you will file as a single person at the state level.
Right. And so these people, in most cases, I guess, are filing an as-if. They put together an as-if federal tax return.
I call it a mock, a mock federal return. They file a real joint return, then a mock single return for each of them that will be the basis for their state individual returns. We've been doing this, of course, for years in California, where same-sex married couples and RDPs were filing jointly at the state level, but had to file as single at the federal level. So we had to fill out a mock federal return in order to do our state return.
Okay. So what do you think about what's happened so far as what the IRS has done in trying to
I think they've done. They've been very clear, and they made it a revenue ruling, which is authority. It's not just a frequently asked questions and answers kind of document. And I think I applaud them in adopting the place of celebration rule. It would be very difficult to apply as a matter of practice any other sort of rule, because your filing status should not change as you move from state to state, and we are living in a very mobile society. And besides, states are more and more states are beginning to recognize those marriages, so that they're moving in the right direction by recognizing a place of celebration rule. And I think they got it right on the retroactivity too. You can file an amended return, and no one has to file an amended return. There's no requirement for that. But so long as the year is open under the statute of limitations, basically it's a 3-year statute that runs from April 15 of the year that you file the return. If the year is open and you benefit from filing married, then you can file an amended return and get your refund. Many people, of course, will be subject to a marriage tax penalty, so they don't have to file a refund, an amended return. And although they didn't make it as clear as I would like, they say that the new revenue ruling that states you will be married and recognized as married at the federal level became totally effective on September 16, 2013. 2013. But they didn't. What they didn't say, and some people were confused about it, was whether or not. Here's an example. Let's assume I suddenly discover I have a $10,000 charitable contribution from 2012 that I forgot to claim. Now, after September 16, I want to file an amended return to claim that. Since I'm filing an amended return after that, do I have to change my filing status from single, the way I did report it, to married status? And one of the co-authors of the ruling, in answer to a telephone question, said, no, you do not. If you're filing an amended return that has nothing to do with marital status, you can elect either to file it married or file it single, if that's the way you filed it originally. And although they have not put that in writing, he did allow us to circulate that conclusion to a listserv that I help manage and attach his name to it. And so we have someone from Chief Counsel's office, one of the co-authors of the ruling, saying you do not have to file, if you file an amended return that has nothing to do with marital status, you can file it as single.
Okay. So how is it going to be different for these people, these same-sex married couples, when they're filing the 2013 tax returns compared to what they've been doing in previous years?
Well, it's going to be a lot simpler for a lot of people. I mean, filing a joint return, especially in California because of the community property rules.
Yeah.
Now, I don't think a lot of married California couples will need to think seriously about filing amended returns because they already got a great break by being able to file a single and still split all of their income under the community property rules. There may be some where it'd be beneficial. But so it's going to be easier. You don't have to go through the community property split. You don't have to, add an addendum that explains how you did it. You just aggregate everything on the joint return. So filling out the returns is going to be simpler. But there's going to be a sticker shock for a lot of people. A lot of people are going to find that they may owe anywhere from $5,000 to $20,000, $25,000 more in taxes. Wow. Because these are mostly high bracket taxpayers, two earners. So there's no income to split on the joint return. And a lot of people didn't think about this, and people should have been increasing their withholding at the end of the year or filing an estimated tax payment. And if they didn't, they may actually be subject to penalties. Now, I did ask one of the co-authors of the ruling, could you put something in writing that says we'd be entitled to an abatement of those penalties? Because, we were filing on the basis of what we thought the law was for that whole year, and he said he thought they would be abated, but he would not put anything in writing.
I would think that, as a tax return preparer, that if they paid in their tax from last year, in most cases, or the 110%, if you added the two
It depends.
liabilities.
There may be other ways to escape the penalties, but not always. I mean, if your income increased dramatically, and if you owed money last year, so that you paid in that amount, but either you paid what you paid last year or 90% of what is owed. That'll save a lot of people.
Yeah. The other thing, so that our people aren't getting into distress over what we're talking about, the interest rates. This is a simple interest computation when you're figuring your underpayment, and the interest rates are very low right now for underpayment penalties. So
it's the penalty. It's not the It's not the interest, but it's the actual penalty that. And I think when people go to a tax return preparer, they're going to catch that. But I'm worried about the people who are doing their own taxes using TurboTax, and it may not be perfectly clear how to handle the penalties.
Well, and the IRS will probably accommodate them and send them a bill, and then we may get some correspondence that's going to happen. Okay.
Now you asked me what I thought about the opinion. I thought it was great on the place of celebration. I think it's great on the retroactive. But the one thing they did that I think is very troubling is consistent with all the other federal agencies who've spoken on this. They've said that registered domestic partners are not going to be treated as spouses.
Right. And
they haven't given us any guidance about how they're going to be taxed. So, for example, we have a strange situation where registered domestic partners are in the midst of a dissolution. Now, dissolution is very like a divorce. I mean, it's practically the same procedure. Alimony may be paid, property divisions may occur, retirement plans may be divided.
And these can be taxable transactions.
These are all going to, queer with it. The divorce tax rules statutes will not apply to them because they aren't treated as spouses. Right. So someone asked me, should I advise my dissolving partners to go out and get married really quickly so they can get divorced? Then we'll at least know what the tax law is. Right. Well, that's clever, but probably not always the best best solution because the marriage has to last for a little bit longer in order to get a divorce. There's some other consequences to think about. Yeah. So I've asked the IRS to consider at least treating RDPs as spouses for purposes of dissolution.
Right. There is another issue, I guess, that I'll just throw out there, and again, this isn't so much a tax issue, and that is a practical one, that when, as I understand it, and you're the law professor, so anyway, that let's say you have a married couple get married in California and they move to another state where they don't recognize these marriages, such as North Carolina.
Right.
And now they want to get divorced. Well, I understand they're sort of in a catch-22.
Well, not if they got married in California. They're lucky if they got married in California.
Okay, maybe you can...
California passed a law a couple of years ago that said if you married in California, California will retain jurisdiction to give you a divorce if at the time you want to get divorced you find yourself living in a state that will not give you a divorce.
Oh, that's pretty
And Canada has now done the same thing, and Minnesota, D.C., and a handful of other states. So I tell people that live in non-recognition states that want to get married for federal purposes, be careful what state you select and go to a state that will allow you to get divorced. You know, they say, we're never going to get divorced. Everybody thinks that when they get married, but we know the national rate is about 50%. So.
Right, yeah. Okay, well, anyway, I'm glad that we raised the issue, and glad to hear from you some of the details about what's happening, that California is favoring on that. Okay. Well, you mentioned the situation of these people that have been married for a while, being able to file amended returns. Is that something that they should be really looking at hard right now?
Well, if they've got a tax return preparer, that person can probably run the numbers fairly quickly. If they prepared the return themselves, they could go back, if they use TurboTax, and just see what their tax liability would be if they filed jointly. But I do think the one great benefit that may change the dynamic here is the fact that health plan benefits provided by employers, if it's provided to the employee's spouse, it's tax exempt. If it's provided to if it's provided to an RDP, it's still taxable. But if it had been provided to a same-sex spouse, it was taxable. That's a huge new change. So, if you've got fairly valuable employer-provided health insurance, some people have their taxes increased by an extra $6,000, $7,000 of income a year.
Yeah.
It might be worth doing that calculation. Now, someone emailed me and said, well, can't I just amend and just claim that now the spousal benefit is tax exempt and that's all I do on the amended return? No, you have to be consistent for that year. If you're going to file an amended return and claim any of the marital benefits, you've got to apply all of the marital rules. You've got to file jointly, you've got to use the joint rates, you've got to do everything.
Well, or
married filing separately. Yeah. Oh, and that I'm glad you mentioned that, because another point that several people from Chief Counsel's office have made is that both spouses do not have to amend and file as married. If one spouse wants to amend, of course, they'll have to file married filing separately.
Yes.
But the other one does not have to amend as well.
Okay. Now, there are also some employment taxes that might have applied, for example, for those health benefits.
Yes, that's separate from income tax.
Right. So that's not something that you report on your income tax return.
No. You file an amended return, a 1040X, in order to get the taxes that were paid on the health care benefits. But as to the payroll taxes, Social Security, FICA, FUTA, the employer pays part of that, and the employee pays the other part. Both are entitled to refunds. And the employer can claim the employer's share of the refund whether the employee does or not, and if the employer doesn't claim, the employee can. The best and easiest way to do this is for the employer to claim both the employer's share and the employee's share. There's a process, it's more familiar, the IRS understands it, and then the employer would be basically collecting a refund of those taxes and paying them to the employee. But if your employer is not doing that, and you want to claim the payroll taxes yourself, you use Form 843.
It's a claim for refund.
It's a claim for refund, particular form. And let me just mention that the IRS, in addition to the ruling, issued a long list of questions and answers for same-sex married couples. So if you go to their website, irs.gov, and you search for same-sex marriage, you'll find it. I've brought a copy here. The official document is Answers to Frequently Asked Questions for Individuals of the Same Sex Who Are Married Under State Law. And that very question was raised. I think it's question 21, and they provide instructions on exactly how to do that.
Okay. And meanwhile, the employer is basically filing an amended payroll tax return.
Yes.
Okay. All right. So, what are some other issues? I had a guest recently on this show. Actually, yours is going to be shown out of sequence because I'm giving you priority since your tax season coming up. But it was a retirement plan expert. And so we were talking about some of the difficulties there in getting these plans cleaned up, and also straightening out things related to distributions and so forth. Maybe you can comment about that a little bit.
Yeah, I mean, from the plan administrator's point of view, now they have new rules that are applied to them because they weren't recognizing same-sex spouses before. Now they do. If the plan happened, a lot of plans have adopted the DOMA language and said defined spouse in the plan to mean only opposite-sex spouses. Those plans have got to be changed. The IRS has issued additional guidance to plan administrators, and there's still more coming on that because there's some very complex retroactive rules. From the individual side, I think what surprises most people that I've talked to, and I've gotten maybe 10 emails on this from different people around the country, they want to know why their employer doesn't cover their same-sex spouse on the health insurance benefit. Especially if they're covering opposite-sex spouses.
Yeah, that's a problem.
And it's a surprise for people to learn there's no federal law that says the employer has to cover any spouse.
Right.
So the plan administrator is quite free to select and define which spouses. It could be, spouses with blue eyes. It doesn't matter. So a lot of employers, not mostly in California. California is a better state for lesbian and gay employees than other states. But the law is that you don't have to cover same-sex spouses just because you cover opposite-sex spouses. In California, actually, you do if you are using third-party insurance to fund your insurance plan. The employer, goes to Aetna or whomever and buys insurance, health insurance, to cover the employees. That's because insurance laws, state insurance laws, are not preempted by ERISA, and California state insurance law says you cannot discriminate against same-sex spouses or registered domestic partners. So if an employer provides coverage to spouses, they also have to provide coverage to registered domestic partners in California.
Okay, yeah. So in a way, California has evolved a little more, particularly related because of having the registered domestic partners for some time. And I guess more sympathy, in some ways, related to the same-sex couples with Jerry Brown as Attorney General and so forth.
Right.
For some time.
I mean, because we had the successful litigation in the state on that issue.
Right. Right. Okay. So, what else do we have here? So, what's happening in the area of Social Security benefits?
Well, a couple of things there. I mean, first of all, the income tax issue that I probably should have mentioned when I said some people might have some sticker shock when they see what their taxes are. Sometimes Social Security benefits are taxable and sometimes they're not. If you're a low-income person, they may not be taxable at all. If you're kind of low income, but not real low, only half of them are taxable. And for those that get over a certain hump, 85% of them are taxable. But if you're married, you have to aggregate your income with your spouse's income, and you may find that even though when you were not treated as married, you didn't have taxable Social Security, you do have it now. That's at the federal level. Of course, California doesn't tax.
So another one is this new net investment income tax.
On the high top end people.
So if you've got this 3.8% tax on net investment income, for married filing joint, it's $250,000 threshold, okay, of adjusted gross income. Once you get over that, then you may have this tax apply. But if it's a single person, $200,000. Well, obviously, 200,000 is $400,000.
That's a built-in marriage penalty there. The same thing for the top bracket, the new top bracket.
Right.
It hits at $400,000 for single taxpayers, but for joint returns, it's $450,000.
Right.
So when you were single, you could have $800,000 of gross income and never hit the top bracket. Now you hit it at $450,000. I'm totally opposed to the marriage tax penalty. I don't think that two necessarily live cheaper than one, or that there are always benefits, and people can live together whether they're married or not. I just don't think marriage is something. Of course, I don't think we ought to have joint returns in the first place either.
No, okay.
We're the only developed country that does.
Okay. Well, in some ways, I'm kind of glad we do. It makes life a little easier for me, but as a tax return preparer. All right. How about estate planning issues?
Well, estate planning issues really just got very simple because we have the marital deduction. That's the main thing that people have gained under it. So you can do marital deduction planning. A lot of people like to leave everything to the spouse and then let the spouse decide whether to disclaim and have it go over to a disclaimer, bypass trust. We couldn't do that before. But now you can do marital deduction planning, and there's this new thing called portability.
Right. Oh,
So that
it's
if
a
you
big
don't
deal.
do any marital deduction planning or bypass planning, then the surviving spouse can take any unused exemption amount from the prior spouse and add it to his or hers, and sort of double the amount that can be left to the next generation.
Right. So
through
you
the
get the
exemption.
same benefits as for other married couples. And again, I mean, that was really the thing that sparked this case with the Supreme Court in the first place.
It was yes, it was an estate tax marital deduction case. Edie Windsor, when she found out that she was, and this was before there were huge exemptions. This was not the $5 million exemption year.
Right, right.
She had to pay $363,000 in estate taxes because the federal government did not recognize her marriage.
Mm-hmm.
And she said she was indignant
Yes.
about that, and so she decided to sue.
Well, it was my $363,000. I might be kind of indignant
Yes,
too.
yes.
Okay. Well, we're really about out of time, so I think what I'd like you to do is just sort of throw out maybe some final thoughts related to this area of the same-sex.
Sure.
couples.
I mean, there are two things I see happening. I do see marriage becoming more and more acceptable, and that I do think there are other states. There are about 20 states that now have litigation going on, or at least 20 cases, and some of them in the same states. One of the interesting ones is in Texas, where people tried to get, a same-sex couple tried to get divorced, and the Attorney General, they granted the divorce, and the Attorney General came in and said no, because we don't recognize marriage. That's before the Texas Supreme Court right now. Okay. So that could be on a fast line for the Supreme Court. So I think we're going to see some developments in the next 2 to 3 years, and we're going to probably hear from the U.S. Supreme Court on this issue of whether or not there's a constitutional right to marry.
Okay.
And then the other litigation area, I think, will be registered domestic partners and civil union partners, not for benefits going forward, but for past events, saying we should be treated the same as spouses. And 3 judges on the Ninth Circuit just ruled that about a month ago. Now, this is not a court case. This was in their capacity as a federal employer. There was a clerk who tried to get her partner covered, and the district court she worked for didn't cover her. And this were past benefits, and the 3 judges on the Ninth Circuit, including Kaczynski, said registered domestic partners look just like spouses. It's a violation of equality to deny them those benefits.
All right, folks, we're all out of time. I hope we've given you some things to think about, and also that will help you this tax season. And we'll see you next time on Financial Insider Weekly.